So I just wanted to say hello to everyone in the audience before we begin. Thank you so much for joining. So my name is Hannah Hilali and I'm a Technical Assistance Advisor at Opportunity EduFinance. And I just wanted to spend a couple of minutes before we begin just talking through what this webinar series is and why we're hosting these series of webinars from now until the end of the year. So this is the first of a three-part series of virtual discussions with thought leaders from India's education and finance sectors. It builds on a recent market research report that we conducted with KPMG back in, I think it was around the end of 2020 last year. And in that research report, what we did was interview schools, we interviewed financial institutions, and we interviewed professional development service providers to find out what were the challenges that these stakeholders found in actually reaching one another. And what we found was that these stakeholders actually listed very similar barriers that kept them distant from one another. And then, so what we decided we wanted to do through these discussions is to shed light on those existing challenges and then also the emerging opportunities and potential solutions to provide access to quality education for all in India. So this first webinar is going to focus on access to education finance. We're going to look at the specific opportunities and barriers for education finance in India. The second webinar is going to be held in October, and that's going to look at access to professional development for low-cost private schools. And that's where our Director of Education Quality, Renee McAlpin, is going to be hosting thought leaders from professional development service providers and other sort of stakeholders in that space as well. And then our last webinar is going to be in November. That's going to be hosted by one of our senior technical assistance advisors, Sakshi Sodhi, and she's going to be looking at technology as a key lever of change for low-cost private schools. So she'll be drilling down into what are the emerging innovative technology solutions that we're seeing in India for education and specifically low-cost private schools. So we'll be putting all of the details of the webinar on our website. It's available already, but we'll be updating it as we start to schedule the next webinars. And we'll also be posting probably a lot over our social media channels over the next few months. So keep an eye out for that. And then just a couple of quick notes. So during the discussion, please use the Q&A box to ask any questions. We really welcome questions, input, feedback from the audience. Our plan is to hold the discussion for around 35 minutes, and then depending on how many questions we receive, we'll then switch to a Q&A session. So the total length of the session should be around 60 minutes, and we'll be sharing the recording afterwards as well. So that's the background. So I'm just going to introduce our panelists. So very honoured to be joined today by three of the top experts in the education finance space in India. So first off, we have Sandeep Vakare, who's the CEO and Managing Director of Indian School Finance Company, also known as ISFC. Which is a specialised lender to education institutions. It's one of the most well-known names in the space, and it's also been lending to the education sector since 2008. We also have joining us Nirav Kambati, who's the managing partner at Kaizenvest, which manages private equity and debt funds in Asia and Africa. Nirav looks after the portfolio in India and is leading entry into sub-Saharan Africa, and all of that's focusing on investments into the future of learning and the future of work as well. And then last but not least, we have Rahul Ahluwalia, who's the Associate Director for Governance at Central Square Foundation, which is a non-profit organisation working with the vision for ensuring quality school education for all children in India. And Rahul focuses on public governance as well as governance for private schools to improve learning outcomes. So thank you all again for joining us. So we'll be focusing today on the needs of low-cost private schools in the new normal, how financial institutions can meet these needs, and then also talking about what are some of the innovations that we're seeing happening in this space as well. So to start us off and to set the scene, my first question is for Raoul. So as we discussed, Central Square Foundation have recently published a report on the effects of COVID-19 on the low-cost private school sector. So I think it would be great if you could start off just by giving a bit of background about low-cost private schools in India, and then also some of the specific findings that you found in terms of what are the needs in terms of access to finance, and then also what are the barriers for schools to access finance.
Yeah, thanks, Hannah. I think to talk about the new normal, it's always, I think, good to just quickly look back at what the old normal was, right? So we had released this report called the State of the Sector Report of Private Schools a year or so ago, just looking at what things were like before COVID hit, right? And for the benefit of the audience, I'll quickly run us through that. I won't spend a lot of time on this. The general idea, of course, is that almost half of India's students go to private schools. 35%, as you can see on this slide, go to private unaided schools, which receive no funding of any sort from the government, and 11% go to private aided schools. And this number has actually grown very, very fast, right? So if you see here in the last 20 to 30 years, it's jumped up from around 9% to what it was before the pandemic hit, right? About 35%. And the interesting thing, of course, is that most of these schools are really low-cost private schools, right? Typically in India, when people say private school, the image that comes to mind is an elite school, a DPS or a modern or something like that, right? But 45% of children who study in private schools pay less than 500 rupees a month, and 70% of students who attend private schools pay less than 1,000 rupees per month, right? So really these schools are very low cost. And as these schools have grown, traditionally the literature has said that, accessing finance has been a significant challenge for schools, right? So one of the big barriers has always been that schools in India are required, not by any particular law usually, but just in court judgments and tradition almost. They have been, and now by many state rules and acts, are required to register as trusts and societies, right? And not-for-profit trusts or not-for-profit societies. And that traditionally has been a barrier, along with a lack of collateral to accessing formal finance, right? So typically school owners, school leaders have preferred to use personal sources of credit, family members, friends, informal money lending setups. And really COVID has, and this is the recent survey that we did after COVID, right? So I'll focus on the right-hand side of the screen, where obviously COVID has had a massive, massive impact on the financial viability of many of these schools, right? So I don't really need to stress on this. I think everyone knows schools have been shut in India since March 2020. Only now are they reopening somewhat. Obviously, their schools are being hit in two ways, right? So their target market, parents have lost a lot of income. Schools have typically had to maintain expenses. In lots of cases, there have been sort of government orders that have required them to not collect revenue and pay out on expenses, right? So what our survey found was that, and our survey actually, because the sampling frame that we had access to was an online frame, we typically managed to sample only sort of relatively higher end schools, although we did try to reach low-cost schools. So keep in mind that we are actually underestimating a lot of what I'm about to say, right? So we found that school revenue decreased anywhere between 20 to 50%, right? And there certainly have been reports that the revenue decrease was much larger than that for many schools. 40% of the teachers that we spoke to said that their salaries had been on hold for at least 3 months, more in many situations. Interestingly, in spite of all of this, right, 77% of schools that we spoke to were not interested in taking a loan. And of the schools that were interested in taking loans, only 3% had actually successfully accessed loans. And 5% were waiting for their loans to get processed. Others either did not get loans or had other issues, right? So, and one data point that's not on that slide is that of the schools that did want to reach out, I think informal lending was a big source that they wanted to reach out to. Public sector banks were another. I think there probably political economy considerations there, right? Like public sector banks occasionally sort of forego loans. They have larger NPAs. They don't necessarily follow up on some of those. So public sector banks were a preferred lending source, and unfortunately, NBFCs were actually not a very preferred source from the people we spoke to. I'll pause there, allow the other panelists to come in, and hopefully we can return to this. Yeah.
Thank you so much. I was going to actually ask Sandeep, were any of those statistics surprising to you, given that I know ISFC has done a lot of research as well into the space, or do you think those findings are kind of aligned with what you've also found?
Yeah, I think Rahul mentioned rightly that maybe his study may be an underestimation of what has been presented here. And that is what my immediate response is. For example, when we are saying 20 to 50% of revenue loss to the school, actually our survey is more on affordable, low-cost private school. And our survey suggests it is not 20 to 50, it is as high as 50 to 80% revenue loss. So that's one thing which possibly is aligned to a low-cost, affordable private school. Secondly, on maybe the survey which would have been done on a better schooling or better infrastructure or larger schools, the requirement of financing from a bank, frankly, for 30, 40, 50 lakh kind of loan or 1 crore loan, banks are really not interested. So for small ticket loan, NBFC are the only financing option. So that is something which we may want to correlate with low cost affordable private school. The reason why many of the schools don't prefer NBFC is because of cost. But at the same time, we have to see whether alternative source and cost from NBFC, whether that is relatively lower or not. And that is something which at ISFC we are looking at very, very closely now. I mean, typically we are a sector-specific NBFC focusing into school financing, that to more of a affordable, low-cost schools. So we were actually traditionally focusing more on the alternate sources like money lenders. I mean, that was perfectly fine, but I don't think any business will run for long run with 18 to 20% kind of interest rate. So we have to see that closely, how that rate of interest is reduced to say 14 to 16% and maybe beyond that over a period of time. And good news is, yes, it is possible by changing certain liability structures. People were actually working in silos. That was a conventional lending model, I generally call. You have 100 crore equity, 500 crore debt, cost of fund is 13%. So you can lend only at 18, 19%. But new structures are coming where this cost can be reduced to 14 to 16% easily. So that's a primary response.
That's great. And Nirav, did you have any comments? Were those statistics news to you, or does it look like what you're also seeing?
No, very aligned directionally with what Rahul's pointed out. So I think the key messages I took away from what Rahul had to say: one, the sector is under tremendous stress, and that's exactly what we're seeing. Prior to COVID, the sector had experienced a phenomenal growth, absolutely the case. Access to finance during COVID has been a challenge, absolutely the case. One point that Rahul made, which really stuck with me and sort of intuitively very true, and Rahul sort of elucidated very, very nicely, is that one of the reasons why these institutions, low-fee private schools, end up going to government sector and PSU banks is also because there is that underlying sort of faith that the system would be more benevolent towards them. In case of NPAs, NBFCs being private sector entities have their own considerations, and therefore they may be a bit more vigilant when it comes to collections and credit management. The other side of the story, coming from the NBFC perspective, is that the NBFC funding at this point in time is pretty much directed towards consolidating their existing relationships. And therefore, there is little room that they have right now to make fresh relationships. And obviously, it's very difficult to strike fresh relationships in a situation where it's a new normal. It's extremely difficult to credit assess new entities and understand what their track record of payment is. So, totally agree with what Rahul's saying, and very encouraged by what actually Sandeep mentioned in terms of possibility of bringing down the cost of borrowing. He's absolutely right. Today, the cost of borrowing is in that range of 12 to 13%, and therefore the rate at which financial intermediaries end up lending to schools is between 18 to 20%. Any way to reduce that would be greatly welcome. So very aligned.
Yeah, and I think that's something that we found as well in our interviews with schools was two of the main challenges was finding a financial institution that would lend to them, and then also being able to afford the cost of that loan, because we know that 18% is going to be a significant amount on top of the actual amount that you're borrowing. I wanted to ask Sandeep, I know we spoke a while back about how COVID-19 had kind of pushed ISFC to transform from traditional lending to one that focuses more on relationships and building those relationships within the ecosystem. Would you be able to share a bit more about that?
Sure. I mean, I would say possibly not only because of COVID, but that was a strategic move ISFC would have anyways made as far as going digital. I mean, because that's the only way any institution would possibly grow going forward. Yes, it has made it more compulsory for a lot many institutions and maybe accelerated the move. But just to tell you, I mean, the way I see this sector is more from a lack of financials. I mean, just to give you some number, private sector affordable schools, 4.5 lakh schools. And if we take even 1 crore of receivable, so it gives us approximately 4.5 lakh crore receivable. Now, this is a very, very high chunk actually to monetize. The issue with financing to low-cost private schools were few folds. One is collateral being owned by society or collateral being non-agri property, because generally in India you would see the properties are agri and then you build a land and building there, because we don't have those kind of laws where immediate faster conversion can happen. So that was one issue. But that also, I think, over a period of time, people have realized, and this question has been asked by a lot many people to us as an institution, that how do you collateralize your loan? But a lot many Supreme Court orders and has come in favor, which suggests that if your land is even agri and you're using it for commercial purpose, SARFAESI is applicable. So people have started looking at taking these collaterals differently now. And these changes has been maybe for last 4-5 years has been there. Institutions have started looking at taking those collateral freely, more freely than before. This will change possibly the kind of players enter into system. Banks may start getting into system. Larger NBFCs may get into financing. If this collateral is acceptable by a lot many people, it will change the structure. And this is what we were seeing. And also, another issue is when you want to digitize any fee receivable, which means that you're actually trying to finance 20,000 rupees or 10,000 or 50,000, which is a very, very micro loan. Physical distribution, not possible at all. Physical collection, not possible at all. It's just not feasible. Or otherwise, you have to charge something like 40%. Then again, it's not feasible option. But fortunately, over a period of last 3-4 years, the kind of technological changes have been there. I think even from a vegetable, and that's what we are also doing, even from a vegetable vendor to even large ITR guy, one can actually assess the customer instantly. And if that is possible, and if you are able to digitize whole ecosystem and connect B2B2C model, which is what our technology transformation that is happening. So 1B is NBFC, then you have school, and then parents. If whole ecosystem is digitally connected, in that case, all that fee financing can be actually monetized. And just to give you a number, 4.5 lakh school is a 4.5 lakh crore kind of receivable. Only in private sector we are talking. So that's a large asset to monetize. And if that is monetized, then your cost of funding comes down. If your outlook on asset changes, then your cost of funding comes down. And I'm saying even if there are 10 players with, say, something like 25,000 crore kind of AUM, this sector needs much more number of NBFCs at better cost.
That's really interesting. And so I guess it's kind of a move from looking at the school in itself to looking at the school in its ecosystem. So you have the school and then the parents that pay the school fees. And if there's an income shock to the parents, then that's going to affect the school, which then also affects their ability to repay. So it's trying to look at all of those different players, which is something that I think in the conversations we've had globally with different financial institutions in this space is also something that a lot have been starting to look at. My next question is for Nirav. So as an investor in organizations in both India and also globally, are you seeing organizations also making sort of similar transformations? And are there any transformations or anything that organizations are doing specifically which have really caught your eye to finance schools in an innovative way?
Yeah, that's a good question, Hannah. In fact, in terms of our experience, we have presence in Vartana in India. We are one of the early equity investors in Vartana. And today, they've done a phenomenal job in terms of reaching out to 4,000 odd low-fee private schools. Prior to COVID, they had gone ahead and built a loan book of about $200 million, which to our knowledge is perhaps the largest anywhere in the world for an institution that's entirely focused on low-fee private schools. And they've had great success in the process, touched about 3 million student lives, made, like I said, 4,000 institutions viable. And the second, more recent experiment is in Sub-Saharan Africa, where we partnered with USAID for the Catalyze program of USAID, and with support from Vartana, Convigenius, and Pratham. We are creating structures in South Africa and in Rwanda that would enable financing to affordable early childhood care providers in South Africa and affordable pre-primary and TVET service providers in Rwanda. One thing which is certainly quite evident in India is what Sandeep mentioned, and that is more and more school-focused lenders are now also very seriously evaluating what they should do around student financing. And there are a few nitty-gritties and there are a few details that sort of need to be sorted out, but the market opportunity certainly seems very attractive. And there are institutions today in India that actually started at the other end of the spectrum. They started with student financing and have had modest success, which has prompted institutions like ISFC and Vartana, who started at the other end of school financing, to also consider student financing more actively. Particularly during COVID, I think one thing which has happened, which is extremely interesting, is that the financial intermediaries have also played a very active role in ensuring that there is some form of learning continuity for students studying in low-fee private schools. And I'd like to believe that they have done that for all the right reasons, but one can't also sort of sidestep the fact that their own fortunes also linked to the schools having continuity of fees. And that's something which has global ramifications. To think of it, consider an entrepreneur who started a low-fee private school. This entrepreneur, the best support system that the entrepreneur had so far was friends and families to fall back on during times of adversity, right? Possibly every other element of the system was in some ways antagonistic. Look at the government regulations. They've always tried to clamp down on these low-fee private schools, and the governments have always been somewhat skeptical of the growth of this phenomenon. As we've seen, parents who send their children to these schools are highly sensitive to the economic cycle, and as soon as there's a downturn, they've stopped paying fees as well. So the only entity that they could fall back on was basically their friends and families, and if they had any savings, which was hardly the case in most instances. But now all of a sudden, you have another deep-pocketed stakeholder that is as interested in your success as you are, and that is the financial intermediary. And that organization has the benefit of scale. So imagine a low-fee private school trying to, on its own, offer digital services or trying to create or implement ERP products in the school to enable fee payment. Herculean task, right? None of the vendors in all likelihood may even entertain such a request from an entrepreneur running a low-fee private school. But now, Sandeep, or for that matter, people who are running Vartana, now they go and sit in front of these providers of technology stacks, providers of remote learning solutions, and they negotiate on behalf of the entire community that they serve. Their bargaining power will be much higher. Their ability to create something meaningful would be much stronger. And that's exactly what has happened. We are seeing financial intermediaries create learning solutions, creating payment solutions, and actually doing a lot to ensure continuity of these low-fee private schools. And in that regard, I must say that India today is at the forefront of low-fee private school financing. And there are many lessons that India could perhaps, in a case of South-South collaboration, pass on to some of the other countries in emerging regions. We're seeing in South Africa and Rwanda, the markets are at a stage where India was at least 5, if not 10 years back. And there's a tremendous opportunity to mature these markets and bring about the sophistication that India has witnessed over the last decade. Back to you, Anna.
Thank you. And I think that's like a really interesting point about the financial institutions actually leveraging their capacities and their influence to then be able to negotiate on behalf of the schools. I think as well this move, like you could be sort of pessimistic about it and say it's just about making sure that schools repay their loans, but I think actually putting in the effort to create these or get these digital solutions and ERP systems and payment systems, I think it shows a commitment beyond just making sure schools repay their loans. actually in education.
Absolutely. I mean, if I just take sort of a 30,000 feet view, it's essentially bringing market-based mechanisms to a development sector like education. And, while these are development sectors and have to be handled sensitively, and one cannot always just view these sectors with a commercial lens, there is certainly a level of efficiency that can be brought to bear by bringing in market mechanisms in these sectors as well.
Totally agreed. So my next question is actually a question for all of the participants, and it's something I'm not actually an expert on, so I'm looking forward to learning something today. And this is, I think it's been brought up a couple of times in this discussion already about some of the barriers of keeping schools from accessing finance is to do with their structures and how they're set up and what the policies actually are in the government as well. So my question for everyone, I'll start with Rahul first because I think you first brought this up. But how do you think the changing policy landscape in India can actually help low-cost private schools become sustainable institutes delivering quality education?
Yeah, I think the structure question is one actually I would love to hear sort of Sandeep and Nirav's thoughts also, right? Like, I think this is the standard narrative has gone for a long time that, the two things that really hold back access to formal credit at large scale for the sector are, one is the structure, because the governance processes, etc., for the kinds of structures that schools are typically set up with are not the strongest, right? They don't have audit processes in place typically, or audit requirements rather. And so, that's one of the reasons why formal credit is tougher to access. But based on what Sandeep was saying, if you have reasonable sort of line of sight into what your revenue flows are, what your and how that's going, there's in principle, there's no real reason why that should hold you back, right? So if that digital ecosystem does develop significantly into a situation where, so right now, and this was actually in our study as well, right now 90% of the schools that we reached out to have a cash ecosystem, right? So parents pay in cash, schools transact in cash. So that kind of insight is a lot harder, right? But COVID has, or will, I'm assuming, shift some of this. Sort of the digital economy has perforce move forward a little bit. So maybe that's one way this will change. And the other, of course, is collateral, which again, this could affect. So actually, I would be really interested in hearing sort of Sandeep and Nirav's thoughts also on how this would evolve. In terms of policy landscape, I personally believe that while the new education policy that was launched last year is very progressive and forward-looking and helpful for the sector in many ways, right? So just one is on the quality side, right? Like, I think the policy calls for key stage assessments, right? And if you have key stage assessments, right, it really provides an independent marker of quality, right? Which in any market is something that providers should welcome, right? Because it drives competition along the right axes, right? Which right now people are having to compete on proxies, right? So people who want to provide good education, who are providing good education, find it very difficult to distinguish themselves in the market, right? Find it very difficult to set themselves aside and show that. So I think key stage assessments are a big move forward if and when they get implemented and when they get implemented correctly, of course. So I think that's a positive step. But on the structure side, right, I think the policy is almost regressive in the sense that it is just maintain that, profit and commercialization of the sector is disallowed, which is a sort of is a stance which really ignores a few realities, right? It ignores the reality of the sector itself, right? Which is that most schools are commercial entities, and the second reality is that profit is never controlled by law, right? It's always controlled by competition. And it's already controlled, right? Like, no school can just charge whatever fees it likes and get away with it because there are other schools competing with them, right? So I think so there are certain ways in which the policy structure is positive and will help the sector, and there are certain ways in which there is still some way to go, I think. And I would like to listen to sort of Sandeep and Nirav's views also. It would be really nice.
Sure. Yeah, you made a very relevant point, Rahul. Structure, as far as our banking structure or NBFC structure, there is a good possibility government has come out with a separate NBFC segment called infra financing NBFC. Now, if education is not infra, what else can be? I mean, possibly education NBFC would be the first one, or these are like sector specific NBFCs one can think of. The benefit of that would be these kind of specified infra financing NBFCs can get access to cheaper finance. I mean, they can go out and create a bond structure, pension funds can invest. So those are benefits. So your cost of funds straight away come down. Secondly, even on small finance banks, so for NBFCs, sector-specific NBFCs who are into education financing, small finance bank is another route. One can get into a small finance banking license and hence get a cheaper access to public deposits. So that's another way out. Thirdly, on instrument structure, I mean, today we are talking only all the NBFCs for that matter. If you see smaller NBFCs to mid-level NBFCs who are sector specific, they are mostly dependent on banking finance. And then unless and until your rating is better, you don't get better, cheaper finance from nationalized bank. So you have to go to private sector and then larger NBFC. That's I mean, water flow of the financing that we get. But I think the way some bond structures are coming up, I mean, you have floating bonds, you can create a bond, maybe higher rating than your own rating. So those structures are available. Now, coming to the rate, I mean, whether 14-15% can actually be possible. As I mentioned, by joint lending, it is 100% possible. So you just need something like even our cost of fund, if it is 11%, even with 2% spread, NBFCs can actually make good profit. I mean, on balance sheet and off balance sheet, I'm saying. So joint lending structure is there where actually IRR of NBFC can be much, much larger. Thirdly, on, as I mentioned, fee financing, if you are able to create a receivable discounting, I mean, these are like controlled receivable that you have. As I mentioned, 4.5 lakh schools, you have 4.5 lakh crore kind of receivables, which is like, if I'm not wrong, 500 billion in USD. So that's the kind of receivable you're sitting on. So if there are certain structures people are able to create, I think cost of financing can be reduced. Accessibility, as Rahul was mentioning, that cost of acquisition of a customer, and that's another part of NBFC, cost of acquisition. And another is the delinquency expectation. If your delinquency expectation is low, costs is somehow reduced, and that is possible with the kind of digital integration that is happening. So new customer acquisition in terms of either parents or even schools, digitally it is possible to reduce cost and go to the schools. So these are certain things which are coming up. I think most of the NBFCs and including us have been proactively looking at that. And as Rahul also was mentioning, you were mentioning in terms of, it is a combined 360-degree relationship that any NBFC should be looking at. Not only financing, but can it be a content? I mean, we have used this very, very effectively. Schools are closed. How will school get fees? I mean, unless and until you conduct an exam. People have been doing online teaching. I mean, content distribution was happening. But at the same time, unless and until you conduct an exam online and you hold back some mark sheet, I mean, that's end result, right? The moment you get into that exam conduction and mark sheet, in that case, people start giving your fee. So we are enabling schools by way of having a relationship with exam management software, some content softwares also. If you go with a package, in that case, the empowerment to school to collect fees is much, much larger.
So you need to have some leverage and something that you can hold back in order to make sure the parents are paying in the time of hybrid learning or digital learning, sounds like.
Yeah, we can't say, I mean, if parent has defaulted, so you have to take XYZ step. The only thing you can go to school and have MOU saying that, okay, they should take NOC from us. I mean, that's how possibly you can monitor.
And this actually brings me, so I think we've got a couple of questions in the chat, but just quickly before we go to them, I had one more question, which I think will be quite interesting for the financial institution that we have in the audience. And it's around risk. So I think, Rahul, as you showed in your initial slides, the growth of the sector was growing almost not exponentially, but growing a lot every single year. And the reason for that was that parents want better education for their children, and government schools are either too far away or the quality isn't good. So we assume this growth will keep on going. And then COVID happened, and this sector, which we thought would continue growing, suddenly stopped and actually decreased. So given all of that, and given now schools are beginning to reopen, and it's kind of like a shaky start, what are your recommendations in terms of creating sustainable portfolios and reducing risk? And also, how do you think investors are seeing this sector at the moment? So I'd open it up to whoever wants to share first.
Yes, traditionally, this sector has always been low on risk. I have been doing this product since 2007. And this product was available even before that. Kotak was initiator of this product, to name, maybe even as early as 2000. And this product has always created a lesser delinquency relatively as compared to any other sector. It is only in COVID that there's like never imagined kind of phenomena that happened. But otherwise, if products are structured well, I think risks in this sector is very, very low. And if parent financing also is done, even if it is costly, but through certain structure, it can be actually almost less than 1% kind of delinquency product. So I don't see risk per se. I mean, it's only a matter of time that one need to get back into business. That's all. And new products, I think digital infra loan. I mean, these are certain new things that will come up. Once you are able to digitize whole system, in that case, you know revenue of a school right at the click of the button. And if that happens, in that case, you can actually create lot many products around that. Working capital loan, for example, 30 lakhs. 40 lakhs, 50 lakhs. Nobody has ever thought of these products for schools. I mean, you want to buy a furniture, you want to have some hygiene toilet making, and there are some funds which are actually financing only this. So it's a comprehensive look, possibly a financial institution can look at, and there's a huge possibility with a very, very moderate risk, I would say.
So, Sandeep, if I may add their perspective, when I look at the 450,000 schools that you mentioned, right? That there are about 450,000 private schools in India that are potentially the target for financial intermediaries like yourselves, Vartana, Shiksha, others. To the best of my knowledge, not even 10% of those schools today have actually been covered through finance. I would think not even, maybe 5% of the schools. And one could argue that the reason why the NPAs are low is because the coverage has been that shallow. We have, as a sector, restricted ourselves to schools that have registration, for example, or are in urban or peri-urban areas, or have a good financial viability any which way. We know that today a very large percentage of the loans are collateralized, which means we have collaterals to secure. We know that these are not greenfield institutions, but institutions with track record. So when we sort of apply as financial institutions all those filters to ensure that our NPAs stay within those historically 3, 4, 5%, now of course much more, we're left with a handful of schools. And I would sort of argue that maybe we haven't yet fully, as a community, explored what happens once we start lifting those filters. Does the NPA remain at the same level? Does it go up? And I believe that therefore there is this tremendous opportunity for impact first investors to step in and maybe catalyze that process for financial intermediaries to deepen their penetration, go beyond urban areas, go to rural areas, go to unregistered institutions. I mean, a classic case in point in a country like India is that we restricted our loans to K-12 service providers because in the stage prior to that, the early care providers, there is no registration formality. And therefore, that's seen as a high-risk area. So that sector has been bereft of lending, although there is a crying need there, and we need to grow that sector. I would like to propose that there's a need for financial intermediaries, along with impact lenders, impact capital providers, to do some more experimentation, go deep, and actually uncover what happens to the NPAs. My instinctive reaction is that there won't be a wide variation in the NPAs. We would still see a very predictable, reliable repayment pattern. But unless we have a track record, that we are very aggressively and actively making those explorations. I don't know what you feel or what Rahul feels.
No, right. You're very right. In a sense, is there? First of all, I think to respond on NPA, I think all of us, all the stakeholders, we need to look at NPAs in a different perspective when it comes to social funding, social sector funding like education. And we are still in our historic era where we are saying NPA more than 2% institution is doing bad. And even if your profitability is whatever, that's the kind of view even rating agencies have today. I mean, you have a 5% NPA, you are a bad guy. You're not doing your job well. Whereas even at 5%, you can still make ROE of 20-22% consistently. So this is something which, as all stakeholders, we need to have a relook at. And this is what I have been actually taking up in most of my conversation with rating agencies as well, and other stakeholders, including lenders. And we have actually started speaking to them, saying that higher NPA is not necessarily bad, because as a credit person who assesses your loan, straight away looks at 5% and says no, institution is bad, whereas you may be a very, very profitable institution. So one is outlook of whole of the stakeholders. That's one piece. Secondly, to answer on NPA, is there a geographical relationship between NPA? My immediate response is yes, data suggests that. But at the same time, I would tend to agree with you that if proper structures are done, and secondly, the reason we have also done analysis of 150 kilometers, what is your NPA, 100 to 250 kilometers. So its graph is definitely like this. But if that graph is seen and then you decide saying that geographical distribution is not good, then you're taking a wrong decision, because the reason for higher NPA is not because of credit. It is because of collection efficiency that you're able to build there. So if you're able to answer these certain questions, in that case, institutions can actually go beyond geographies, and there are structures available to go beyond geography. How that can be effectively managed, that definitely is a very big possibility. So, and thirdly, I think from a institution side, I mean, 22% ROE is good for even a commercial organization. And even if we call ourselves a social, and we have started calling that as far as ISFC is concerned, we are a socio-commercial organization. And by change in terminology, I mean that whenever we go to 22-25% kind of IRR, in that case, pass on that benefit to the customer so that you scale up faster, and that 20-25% continues for a longer period.
Yeah, I mean, I don't have much to contribute to sort of the financial pieces of it, but on the sectoral side, Hannah, to your question, I think, yes, it's been a huge shock to the system. So in terms of risk, obviously right now, risks are all over the place and will likely continue to be for the short-term future, right? Like I think people's incomes, etc., will take time to bounce back. But in terms of the medium-term drivers of the sector, we actually don't think much changes, right? I think parents continue to have the same kinds of aspirations which led them to the sector in the first place. In fact, in our survey, we found almost 80% of parents, and on the parent side, we didn't have the same limitations we had on the school side, right? So we did not reach out to more affluent parents. And we found that around 80% of parents maintain that they want to continue to send their kids to private school, right? And this is in the middle of the grip of sort of the pandemic wave, right? And now things are going back to normal. I think it is going to depend a lot on the macro situation, right? Like how quickly do we bounce back? What kind of policy support do we provide to dampen the effect of the shock, right? So I think that's in the short term, but in the medium term, I think the drivers remain similar to what they were before.
Great, thank you so much. So we're into our last 6 or so minutes, so I'm going to ask a couple of the questions that came through from the audience. So we've got one about financial regulation in India. The question is, does it hinder the ability to reduce the cost of borrowing, such as requiring minimum interest rates for particular types of borrowers, which is a case in Ghana?
Can you repeat that? I didn't get that question properly.
So it's, does the financial regulator in India hinder the ability to reduce the cost of borrowing? So it's basically, does the financial regulator require a minimum interest rate to be charged, depending on the borrower?
No, we have no such regulations that I'm aware of. It's just purely a function of the cost of borrowing and the risk attached with it. As a matter of fact, the Indian government, I must say, since we've sort of expressed our displeasure with the regulatory environment, I must add that one very positive development is that the credit guarantee scheme, which was rolled out by the government, is also applicable to the low-fee private schools, which sort of gives comfort to the financial intermediaries to be a bit more forthcoming in their lending to the sector.
That's really interesting. So then that will give a bit of room to maybe explore some of these more riskier schools in terms of geography and differences.
In terms of, just going back to one of your previous questions, in terms of what are we seeing around the world, one very interesting thing that I noticed in Pakistan is that lending to these institutions is now part of priority sector lending. And that sort of opens up a fairly large amount of capital that can be made accessible at relatively low cost, because it's coming from the public sector banks to these institutions. We are far from doing anything like that in India right now.
Yeah, I agree. There are a lot many things one could have actually thought of doing more than what we have already done as a policy maker from government side. For example, ECLGS, you mentioned, credit guarantee scheme. When that mandates loan to be given to the borrower at 14%. Now, how does our kind of institution participate in that? I mean, our cost of borrowing itself is 13.5. So that is something which one could have done better there by creating some structure where we could have access to some fund at 11% and then move that fund at 14% to these institutions. And that's the reason possibly that ECLGS scheme, the right set of customer. I mean, schools were actually most affected. And frankly speaking, they got the least of ECLGS, I would say. I mean, we wanted to do, but how can we do is a big question at cost.
That makes sense. And then, so I think we've got time for one last question. For anyone who's asked questions that we haven't answered, we'll respond to them after this session in writing. So this question is about digital literacy divides seen in low-cost private schools. So are you seeing a divide in low-cost private schools, but in urban versus rural schools? And are you doing anything to address that divide?
Nirav, Rahul, or otherwise I can take that.
So absolutely, very stark divide, digital divide being witnessed in these schools. I recall we had gone ahead and launched learning continuity programs using digital technologies. And while we continue to do that, we had to quickly supplement that with paper-based solutions as well to ensure that we have higher participation for remote learning among students of our customers. So it is a matter of fact that device availability and availability of reliable bandwidth is a cause of concern at homes which send students to local private schools.
So my response to that is yes, digital divide definitely is seen in terms of socio-economic division, in terms of learning opportunity. I mean, the survey that we have done, it clearly suggests that there is a huge divide when it comes to urban student and rural student. That's one part of digital divide division. Second is that digital division also has created a gender division. In a sense, in Maharashtra, for example, 58% of male student, they got access as compared to only some, if I remember correctly, 8 or 9% of female students. So in a family, then you're talking about if I have son and daughter, typically in rural India, you would see sons are preferred that, okay, use this device, and only then if time permits, then daughter will use. So that's the kind of division we have seen. But at the same time, this is a very, very short-term thing that we are actually looking at. But over a period of time, I think because of digitization, content standardization will come up, which means that whatever contents are available to urban student will be available to rural student as well. So I see that positive in medium to long term. So that's my response on digital divide.
Great. Thank you so much. I feel like I could ask you so many more questions, especially that statistic on the gender divide in digital access. But unfortunately, as we are at time, so I have one last quick question to ask. So as we've called our webinar series, what's next for low-cost private schools in India? We're asking each one of our panelists on the series to just give a quick, could be 1 or 2 sentences on their own opinion of how they would summarize the future of low-cost private schools in India. So really, in your opinion, what is next?
So my response is only digitize. That's all. I mean, that's the way possibly everything is going to change. Access to financing, number of the way you serve school students, everything is going to change. And COVID has influenced that quite a lot. Our July survey, I mean, we have done 3 surveys to touch base with schools. July surveys suggested 20% of digitization. Now it is 80%. So it's all reversed. So people have actually lapped up digitization big way.
Great. So digitize. That's an easy one to remember. I like it. Nirav, over to you.
Well, like Rahul said, I think in the medium term, we strongly believe that low-fee private schools are here to stay and they'll bounce back. As a matter of fact, our belief is that demand will come back sooner than supply, and therefore there's likely to be a supply shortage in the midterm because not all the institutions will be able to see this period through. But having said that, I also would like to believe that we are now at the end of the COVID-induced lockdowns, and there's increasing amount of recognition at all stakeholder level that we need to reopen our schools at the earliest. And once that happens, life will very soon revert back to pre-COVID days for the local private schools.
Great, thank you. And Rahul, last but not least.
Yeah, thanks. I did already say, of course, that in the medium term, we do see demand being similar. I do think that the sector and government and policymakers need to come together on a few structural things that are holding the sector back, right? I think one structural piece is on the quality side, which I mentioned, right? Like having an independent marker of learning quality is really key to sectorally drive learning outcomes up, right? Like if you see before COVID, learning outcomes were stagnant in private schools, right? In any other typical market, outcomes improve, quality improves over time, right? Costs go down or stay the same, right? It's not quality that stays the same. So we need sectoral incentives to improve quality. And I think unless we sort that out in this sector, that's going to be a long-term risk, right? Because there's going to be this kind of sort of representation of the sector as, something that's not a good thing, right? Like, so you find this often, right? Like narratives about the sector in media, among politicians are quite often antagonistic, right? And that's going to continue until and unless we find structurally a way to represent that there is high quality, that quality is improving over time, that there is benefit to society and to customers coming from this sector. I mean, there obviously is. I'm not contesting that there isn't, but that needs to start getting represented more structurally. And of course, simultaneously, the regulatory space has to be freed up. The sector has to have space to innovate. It has to have space to formalize, to access more formal credit, grow, scale in ways that other sectors do. Right? So, yeah, I will pause there since we're already well over time.
Great. Thank you so much. And also apologies to anyone who asked questions that we didn't manage to answer. I just saw a couple more questions come through, but we will get back to you after the webinar. So I just wanted to thank you all again, Nirav, Rahul and Sandeep, for joining us on this, our first webinar series. Thanks so much for a really interesting discussion. And yeah, hope you all have a nice day. Thanks again.
Thanks, Hannah, for having me on.
Thank you so much. Thanks, everyone.
Thanks. Thank you.
Thank you.